Okay, well, welcome back to Self-Managed 360. This is our second video on stock market investing. So we will discuss the stock market's environment. As we've said in our previous video, stock markets are driven by the laws of the market, so supply and demand, but they're also driven by the fundamentals of the companies that are trading on the stock market. So basically, we should look at the stock markets short term and long term. Short term, stock markets are driven by emotions, they're driven by popularity, and are also hype driven. So basically, we want to avoid investing in the stock markets solely on our emotions, and we don't want to get stuck in the hype and on the popularity of some stocks other than other stocks, for example. We will concentrate on the long-term perspectives of the stock markets, and their often stocks prices are going to be representative of the value of the company. So it will reflect the profitability level, the expected growth, and will also take into account how a company is doing. Is it financially sound? And the emotion long term will be balanced by the overall performance of the companies. We are going to discuss the indexes because there's you can invest on the stock markets by simply purchasing the fund that is tracking indexes of various stock markets, such as the Dow Jones Index or the S&P 500s, or if you want to invest in Europe, there's also funds that are tracking European market index. But we will discuss the index now, but as we go into our investment strategy, we'll be focusing on individual companies because what we will try to do is to do better than the average stock market indexes by picking and choosing companies that are going to provide us an overall return that will be higher than the indexes. So if we look at the screen here, we see I've put two screenshots of one on the left is the Dow Jones Index for 1929 to 2013, and I've also put the S&P 500 from 1950 to 2016. So basically, as we see, for example, an investor that decided to invest in 1998, and if that investor decides to purchase the index of the Dow Jones, he had a pretty nice year in 1998 and 99, and then there was some kind of a crash here, only to go back up, only to go back way down. This is 2000. This is actually 2008. If you remember, in 2008, there was a financial crisis. Some big companies in the U.S. were stuck with bad debt. I'm not going to go into trying to explain this because it's quite complex, but there were some companies that were in serious financial trouble, and it brought the whole market down. But we need to remember that even if the Dow Jones Index fell, and we can see that the S&P 500 also fell big time, we need to remember that in the Dow Jones Index, in the S&P 500 Index, there are companies that are not related to the financial crisis, that because of the bad hype that was surrounding stock market investing, the overall stock prices of these companies fell with the banks that were in trouble. So this is caused by popularity, emotions. During 2008, 2009, stock markets had the bad hype, was unpopular, and traders were trying to sell their positions to recover their money. and to invest their money into more safer investment opportunities. So that caused what as we've said in the first video, that caused a supply demand that was higher. The supply was higher than the demand, so more people were willing to sell. So it kind of put a lot of pressure on stock prices overall, and some companies began selling at a big discount. We need to remember that even in this troubled time here, some companies were making a profit, were in very nice and very sound financial health, and they crashed just because of emotion and hype, or bad hype, I would say. However, as we've seen, it recovered sharply. Okay. Both the Dow Jones and S&P 500 indexes. So the question here is, if you had invested in the stock market in 1998 and you decided to buy good companies and to keep them, even if bad times comes and they will come, what would you do here when it starts to crash? You know that you bought the company at this price here, around this price. This is obviously the indexes, but let's say that that's the, the diagram of the company that is not in bad shape at all, it's making profit, and crashes here because of bad news coming from other companies. Well, if you trade on emotion, you will probably start to panic here and you will probably sell. But if you decide to wait and see, knowing that your company is doing good, well, then probably you would make a good move by just keeping your stocks. Here it stops in 2013. Here, as we see on the S&P 500 index, we go all the way to 2016, which is our last year, actually. So you can see that the index increased and it was way over the top reached in 2008 and in 2000. So what we want to stress here is that our investment strategy will be aimed at purchasing stocks that are solid. We will keep an eye on them regularly to make sure that there's no bad fortunes on profits, on financial health. And we will try to, even if it's not always easy, we will try not to be influenced by whatever can happen on the stock market investing world, on other companies that are not related to the companies we own. Sometimes a war can have an impact too, or political events such as the Brexit or whatever can actually cause some kind of bad feelings about where the economy is going, and it may and at some point it will impact the stock price of even very good companies. The thing is, long term, the financial performance of good companies will push the stock back to where it should be. So, as we will see in the following videos, we will discuss how we can actually pick and choose companies that should be able to go through storms on the stock market investing world to go back to increasing in value, even if it hurts sometimes to see the value of our portfolio shrink because of unrelated events. It's worth going through these storms and only convincing ourselves that the companies we own are still doing good, and at some point the stock markets will reflect the individual performance of the stocks we own, so that the value of our portfolio will keep growing in the future.